world, and we have talked about it many a time in the past. I'll repeat it. Those who are not speaking, could you please mute your lines? Those who are not speaking, please mute your lines.
Somebody's TV is switched on.
If somebody has a TV on, they can choose whether to watch the TV or listen to the press conference. Could you please mute those volume indicators, please? Thank you. India continues to be an outlier, and we have mentioned the reasons for it in the past. It is because of the ability to withdraw the COVID stimulus, and also by keeping the creating fiscal space, and also making sure, I think the external noise is still coming, please. Can you please mute those lines?
Whoever has got their TV switched on, please switch off your TVs while the briefing is on. Any other device which is on and whose volume is on, please switch it off.
So the reason for India's performance continuing to do better is because of the COVID management, as well as the emphasis on capital investment, which has now begun to crowd in private sector as well. Industrial sector growth, as I mentioned earlier, has picked up quite well. You can see it in the gross value added sectoral growth breakdown as well. Mining, manufacturing, construction sectors. Could you please mute your lines? There is a lot of ambient noise. Can you please help by muting your lines?
This is Oct-Dec and BTTV. Please mute your mics. Oct-Dec and BTTV.
Mining, manufacturing, and thank you. Mining, manufacturing, and construction sectors gross value added. You can see that both in nominal terms and in real terms have done quite well. Of course, if you look at the growth rate in the first 9 months of GVA in these sectors, real growth is higher than nominal growth because they are usually deflated by the wholesale price index, which has been negative this year in terms of the year-on-year change for the FY24, and that is the reason why the real growth rates are higher than nominal growth rates. That said, even the nominal growth rates show a good recovery in these sectors. Hello, can you please help me by muting your lines? Hello. So industrial growth rate has now picked up. That's why I said there is a better balance of growth, and I already walked you through the reasons why agricultural sector's gross value addition is lackluster, but I expect a recovery next year. And the economy macro vulnerability index, which you have prepared, and the details are given below. The macro vulnerability index is actually trending down, which is as it should be when the macro vulnerability index goes down. It did pick up in the years leading up to the pandemic, and now it is on its way down, which is a good sign that the overall macro economy is displaying stability, because it is calculated by a simple combination of fiscal deficit, current account deficit, and retail inflation. This is also shown in the macro uncertainty index for the Indian economy. And if I look at the agricultural sector performance, we have talked about it earlier already, so I'm not going to go into the details. I've given you my explanations for the tepid performance this year and the reasons for the recovery next year. In terms of industrial growth, as one would expect, as the private sector investment begins to rise, and as the rising incomes and consumption recovery in general spilling over from last year to this year is also now crowding in production. We can see that in the continued ebullience in the purchasing managers index, IIP growth rates, and increase in cement production and steel consumption, and also in the steady pickup in the railway freight traffic growth as well. In terms of the services sector, although once again the hospitality sectors show a slightly lower growth in the current financial year's 9 months compared to the previous year, we must remember that it is coming off a very strong recovery in FY22 and FY23. It is more a sign of stabilization rather than any underlying weakness at the moment. Purchasing Managers Index in the services sector is doing even better than the manufacturing sector. Digital transaction volumes and foreign tourist arrivals are now appreciably above the pre-pandemic average. And in terms of the revenue per available room is rising, and the overall daily rate is also picking up, so indicating good business and leisure travel in the country. Urban demand conditions, whether you look at passenger vehicle sales or domestic air passenger traffic, overall consumer confidence, and as I mentioned earlier, construction sector recovery is also evident in the housing sales. Now, there is always a question mark in people's minds, notwithstanding evidence. People tend to go by their perception, but the rural demand, as you can see on the top left, volume growth in rural fast-moving consumer goods has been rising for 4 consecutive quarters starting from Q4 of the last financial year. And both 2 and 3-wheeler sales are on a rising trajectory. Increase in tractor sales we have seen in January over December, and in general in the current financial year we are seeing tractor sales doing quite well. But as I mentioned earlier, with the anticipated better value addition in the farm sector next financial year, rural demand growth and rural income growth will be even better and more evident in FY25. And then if you look at the household monthly personal consumption expenditure, we can see here compared to the 10 years ago when we had the household consumption expenditure survey, we can see the big recovery in the overall consumption spending in rural India and urban India. And many news reports have shown how the share of food expenditure has come down in both rural and urban India, giving them more space for discretionary expenditure, and how much of the expenditure growth has happened in the lower fractiles rather than in the higher fractiles. So in general, the story is one of rising purchasing power and reduction in the poverty headcount ratio, as well as a better distribution of consuming power in the hands of the population, more so in rural India than in urban India. Now, moving on to the inflation data, food inflation has been volatile, but we must remember food as a share of expenditure is coming down, and the bottom income segments of the population are shielded by the food price inflation by the government's Pradhan Mantri Garib Kalyan Anna Yojana program, which is now extended for 5 more years. So in some sense, the food inflation as measured by the data is not exactly the food inflation that the actual consumer faces, because many of them do get at least certain quantities of food items for free. So in that sense, the food inflation does overstate the impact on the consumer wallet. Stable food prices assisting in lower inflation. WPI inflation has entered positive territory now. That is why you are seeing it in the recovery in nominal GDP growth numbers now at 9.1%. Inflation expectations remain stable to slightly lower. In fact, the current perception is quite low, and the 1 year ahead perception has remained slightly lower but stable. Global demand has been a challenge given uncertain global growth. Many regions of the world, Europe and East Asia, are showing moderate growth, and therefore overall export growth performance has been middling at best. But nonetheless, due to the decline in prices of manufactured imports and also decline in services imports, the overall service sector surplus is quite good, and the overall trade balance, the deficit, is shrinking. So the external sector is showing no signs of vulnerability despite the poor performance of exports in general because of global demand conditions. We must also note that, however, remittances by Indians went to achieve a record in 2023 and will do so, expected to do so again in calendar year 2024. I just spoke to you about the external sector being stable. Current account deficit is heading towards just 1% of GDP. And the forex reserves now cover about 11 months of imports, and FPI flows are at $33 billion. We should also note that the gross FDI inflows into India are doing quite well compared to the last financial year in the first 10 months of the current financial year. The net FDI flows, after we take into account repatriation, is lower, but then repatriation arises on account of investments made at any time in the past. They do not reflect the current sentiment, and sometimes repatriation also happens when the investment has been extremely profitable, and as the underlying investment goes public, that investment is picked up by portfolio investors. So in that sense, focusing on gross FDI to gauge foreign investor interest in India is more appropriate, because repatriation doesn't pertain only to the current financial year, but it could be arising on account of investments made at any time in the past. Government's commitment towards fiscal management is evident in the fiscal deficit as a percentage of RE in the first 10 months of the year, and also in the tax collections, as well as in the continued steady increase in the average monthly GST collections as well. If you look at the quality of expenditure, year-on-year growth in capex in the first 10 months compared to year-on-year growth in revenue expenditure, and the overall decline in revenue to capital outlay ratio by more than half, 7.5 to 3.7 times the ratio, shows continued emphasis on capex and continued monitoring of the quality of fiscal expenditure on an ongoing basis. Private sector investment activity is evident in micro data as well as in aggregate data. Import of capital goods, increased production of infrastructure and capital goods, and expansion in the capacity utilization in the manufacturing sector, and more importantly, in the actual data of investment by private non-financial corporations. From around 4.6 trillion rupees in FY19, we did face a dip in the next 2 financial years. But however, the recovery since then has been quite significant and fast in terms of ramp up. So we have said it many times, private sector capital formation is not a story for the future. It is a story that is unfolding as we speak, and we expect it to sustain on the back of the improvement in infrastructure facilities, and also with respect to reasonable tax rates, reasonable interest rates, and a continued nurturing policy environment for investments in general, not just foreign but also domestic. As you are seeing in the data on the first 6 months of the current financial year, running at 3.4 lakh crores compared to 3.1 lakh crores in the last financial year. This is based on data pertaining to over 3,300 companies in the private sector. Banking sector story is well known. At the same time, we are also aware that both the government and the central bank are focused on ensuring that banking sector remains viable and healthy for a much longer period than we enjoyed in the previous cycle, so that we don't repeat the mistakes of the previous cycle when there was excessive and rapid growth in credit burning out very quickly. So that is why I think the growth in non-food credit is moderating, excluding personal loans, at 15%. And banks also are beginning to place more emphasis on deposit mobilization, so that the credit to deposit ratio remains at reasonable levels rather than being excessive. Urban employment indicators are continuing to decline, and net payroll additions under EPFO, even though there was a slight slowdown in the months of September to November, once again picked up quite strongly in the month of December, as we can see in the data. Overall, general government spending, none of this is actually coming at the expense of the government's attention to the social sector. If anything, the macroeconomic data reveal the success of the two-pillar approach of the government towards economy in general. One is economic growth through infrastructure and public investment, and inclusion through empowerment. These two pillars have defined the macroeconomic policy landscape, contributing to a much robust recovery in India compared to other nations post-COVID. And you can see that in the overall quality of general government spending, which includes state governments as well. As a percentage of total expenditure, it has gone from a low of around 23% to near 26% in the last 3 years. And the numbers in absolute terms has also been rising very steadily from just under 10 lakh crores to over 20 lakh crores just in the last 8 years. Overall, we believe that given the prospects of a normal monsoon, good Rabi sowing, prospects for rural income growth, and pickup in manufacturing and mining sector growth, and a pickup in bank credit growth, which has been unfolding. So overall, the Indian economy ticks many boxes in the right way, continuing to grow at around 7%. And now, if there are question marks that are coming, they are coming from the external world because of the continued geopolitical uncertainty and moderate to slower economic growth elsewhere. Possible other repercussions may also come in terms of global risk aversion if the financial market exuberance in the developed world gives way to more realistic expectations of earnings growth. And as we know very well, it is a year of elections, not just in India, but in several parts of the world, and outcomes so far have been somewhat unexpected in several countries in the world, and those in turn have imposed their own uncertainties on their macroeconomic policy framework and growth prospects. So these are the external risk factors that we have to bear in mind. And the ongoing risk factor is, of course, the challenge of managing energy security and energy transition, which India has been able to handle quite well compared to others. We are continuing to secure energy for Indian households and businesses because power cuts are a thing of the past, and there is a national grid, and grid stability is being ensured even as the country continues to increase the share of non-fossil fuels in its overall installed capacity. But nonetheless, that is a medium-term challenge which we face. So as you can see on this slide, high frequency indicators point to continued good performance in the fourth quarter of the current financial year. Most indicators are either yellow or green rather than red, and that is a good sign for the growth momentum to continue. And based on the projections for FY24, which is now the MOSPI is showing at 7.6%. This has been the projections made by several other international organizations. So the actual performance of the economy has continued to defy expectations and do better than what many had projected, underscoring the fact that a structural transformation of the economy is indeed underway, both in terms of physical infrastructure and digital infrastructure, as well as inclusion agenda, boosting the purchasing power of Indian households, which we saw in the household consumption expenditure survey data as well. So there is a case for many agencies to reappraise their estimate of potential GDP growth in India to closer to 7%, if not above. And let's also remember that the central bank, Reserve Bank of India, is projecting 7% GDP growth for FY25 as well. Thank you very much, and I'm open to questions.
Thank you so much, sir, for the detailed briefing. Now we
the rural demand will be better next year because of the likely improvement in agricultural sector. So what gives you the confidence that agricultural sector will do well next year? And second is the government expenditure. If we see the first month of the fourth quarter, we see decline in revenue expenditure, sharp decline in capital expenditure, while revenue expenditure has also slowed down.
So I explained the reasons for expected better performance of the agriculture sector. In fact, I spent quite a bit of time on it, pointing to the fact that Rabi sowing has been quite good compared to last year, flat or unchanged. It's not lower. El Nino has been predicted to be withdrawing by several international meteorological agencies, and normal monsoon is expected in India, and therefore I expect the agricultural harvest, farm income, and rural incomes to do better. So I have explained my reasons. Now, as far as the overall government expenditure in recent months is concerned, it is not something that we should be looking at on a month-by-month basis. The revised estimates suggest that the government does indeed plan to meet its capital expenditure. There is a slight shortfall, but overall, the 10 lakh crores capital expenditure that was projected in the budget estimates for FY24 will be achieved to the extent of 9.5 lakh crores, etc. Next question, please.
Surabhi, next in line is Surabhi. Surabhi, please ask your question. Then we move on to Janani from NDTV Profit.
Hi, good afternoon, sir. We are seeing manufacturing growth showing a good boost. Is there a way of understanding the contribution from the PLI scheme? Is my question, sir.
It is not possible to answer this question at this point. We have to, and PLI schemes are unfolding as we speak. It may be possible to assess their impact after the scheme has run for a couple of more years, because even now investments are trickling in, and at this point it may be difficult to give you a precise attribution.
Nikunj from Reuters.
Hi, sir. Wanted to ask you about the divergence in GVA and GDP growth, if you could help understand that. And a follow-up question, how sustainable do you think this high growth is, considering the investment is led by the government and consumption still remains weak?
I don't understand the first question. What is the discrepancy between GVA and GDP?
So the GVA growth is at that's the divergence.
So the discrepancy has always been there for since the time GDP data has been there, and this time, in fact, the discrepancy in the expenditure estimate is negative, which means GVA growth numbers are higher and GDP growth numbers. If the GDP by expenditure methodology is able to match the GVA numbers, it would be even higher. And naturally, for the expenditure approach, data comes over time. That is why you have 5 or 6 different estimates of GDP. So this is nothing new. And your second question about manufacturing.
About growth.
Yeah, the sustainability of the growth rate. I think I sort of spent some time explaining that the private sector capital formation has actually begun to unfold, and I showed you and I shared with you the data, and I also gave you the explanations for why agricultural sector will do better next year. Third, I also showed you for the near term the current status of the vigor and the dynamism in the high frequency indicators. These are my 3 explanatory factors.
Now we move on to Siddharth from Money Control.
Hi, sir. Siddharth from Money Control here. Just a follow-up to what Nikunj asked, the GVA and GDP growth divergence, that seems to have happened because subsidies have been sharply lower in the third quarter. So is it perhaps better to look at GVA growth in generally rather than GDP growth?
This is an issue that will continue to remain, and it has been the case for several decades in the past. I don't see much value addition, gross value addition or net value addition in focusing on this.
Next, Sumit Chaturvedi from ET Now.
Sir, I would like to ask you if elections, you said elections in India and other parts of the world can impact the economy in any way. So could you elaborate on that?
I didn't say that. I didn't say that. No.
Okay, sir. Fine.
Sapna from CNBC.
Hi, sir. So just 2 quick ones. Government has decided to drop the third revised estimates that was expected for quite some time. So could you share with us the reasoning of course, I mean, known, but still share with us, and how many prints will be there now? That's one, sir. And second,
I think this is a question that is better addressed to MOSPI.
Okay. And second, sir, my colleagues have already asked this. I mean, how does the government expect this to sustain these high growth numbers? And you spoke about
I just explained.
you spoke
I
about
just explained.
sorry, I'll just complete quickly. And you spoke about agencies, I mean, needing to revise their numbers for the current financial year. But for FY25 also, sir, don't you think the government has been conservative, just indicating around 7% odd? Thank you, sir.
In general, the policy on fiscal projections has been to be conservative, both in terms of growth numbers and revenue buoyancy. So the government has continued to adopt that stance. At the same time, it is evident from the data and from the underlying performance of the economy, because growth rates for previous years has been raised to 9.7 and then 7.2, coming down to around 7, and this year current estimates are at 7.6. And next year the central bank has 7. So on that basis, I did say that there is possibly a case for international agencies to take a look at the structural transformation happening in the economy and examine the case for a higher potential GDP growth estimation.
Kriti from Informist.
Sorry?
Kriti from Informist, please ask your question.
Hi, sir. Good evening. Sir, first of all, given the current trend, do you see a further revision in entire FY24 growth in the provisional estimate? And what would be your outlook for the Q4 growth figures?
No, I mean, we have just got the second advance estimates of 7.6%. I think that and by the time the new estimate comes out in May, it will be difficult for me to we don't do that kind of granular forecast. And for FY25, I think we have given a number of 7 points. RBI has given a number of 7%. So we will go with that for the time being.
Ruchika from Business Standard. Ruchika, please shoot your question. Okay, then we come back to Surbhi again. She couldn't earlier take the question. Surbhi, please go ahead.
Hello, sir. So just wanted to understand your perspective on manufacturing sector growth, and do you see this remaining sustained, because we've been trying to push up manufacturing growth for some time? Thank you.
I think I have answered this question that as the manufacturing sector growth is picking up, because in the previous decade we had problems with the balance sheets of the corporate sector, and the continued growth and recovery in private consumption demand. I showed you the chart of both urban and rural, charts on rural and urban demand. Several slides, 8 slides were there for these two rural urban demand indicators, and urban demand also and rural demand also has been rising for 4 consecutive quarters. So naturally the manufacturing sector has been performing well, and I even explained to you that I'm not even going by the real GVA in manufacturing, because it is overstated by the WPI deflation, and I looked at the nominal GDP growth, and that is a good sign that manufacturing is recovering. It is obviously the case that in an economy as large as ours, some sectors in the economy will be growing faster, some lower in different phases depending on the underlying conditions. And manufacturing sector recovering in FY23 and further in FY24 is a sign that it is putting behind it the balance sheet issues of the previous decade, and also it is a sign of the robust underlying demand conditions.
Now we take the question from Karishma, Business Today.
So, good morning, sir. So, can the upward revision for FY24 GDP make room for modifications in fiscal deficit from 5.8% in percentage or absolute terms?
We need to look at the numbers. As I said, these numbers come out 1 hour before, and I'm sitting some few thousand kilometers away, and we have managed to put together a set of slides to be able to give you a broad picture of how the economy is doing. So it is a good question, and I think the budget division and the finance secretary will be able to answer that question.
Vikas Doot from Hindu has a question. His mic is not working. So he wants to know that when the earlier estimates for 2022-23 GDP growth had come in, you had expressed the confidence that the final estimates, as and when they come, will reflect even higher growth. Are you a bit disappointed to the extent now that last year's growth has been downgraded to 7%.
Well, I mean, then I should point out the fact that the estimate for FY22 has